Hey traders, welcome to Charts and Huge Mugs of Coffee. Happy Tuesday, everybody. Happy PPI Tuesday. Let's take a look at what this post-PPI environment is looking like. Now notice, I'm not looking at the charts, right? I'm not looking at, what kind of move we saw in the wake of that number. Heck, I won't even look at the number initially. Where all the data is landing for us as traders and even investors continues to be how we are collectively using Fed fund futures, which are monthly futures contracts that speculate on where the rate is going to be from the Federal Reserve month after month. Some of these months are going to overlap with all these months are going to overlap. It's not every month, nearly every month are going to overlap with the meeting. So at every potential movement, message, we're going to have a Fed fund futures contract related to it. That's what we're looking at. Okay, having said that, much like we would look at bonds to understand what the yield is, it's kind of the same thing. So if you're wondering, Rog, I don't get this Fed fund futures concept. If you're comfortable looking at TLT or ZB futures, this is sort of that, but for the Federal Reserve's rate. All right, having said that, take a look. I'm going to refresh this and make sure it hasn't changed much. And this is going to be the May contract. There you go. This is staying pretty steady. What is this showing us? Well, this graph are all the possible, not probable. There's one probable. There's, in this case, 5 possible places rates can be come next May. And it seems to be ever since that cooler CPI and now a cooler PPI. By the way, what the heck's a PPI? What is the cost of the finished goods, right? That's kind of what it's measuring. If that's lower, what does that say about inflation? So you've got a CPI, PPI, 1-2 punch, continuing to factor in a 4 3/4, 5% target rate probability peak. What's another way of saying that? You'll hear the lingo terminal rate, right? I like to say peak and plateau. What are they hiking up to and where are they going to stop? And this is continuing to look like at 4 3/4 to 5%, even though 5 to 5 1/4 is in hot pursuit, that 5% range seems to be what we're expecting. If that remains steady, then yeah, gang, we're going to continue to see US dollar drop. We're going to continue to see the S&P futures continue to move higher, period, right? Other stuff, don't care. Market doesn't care, right? I'm not saying I don't care. I'm not saying we shouldn't care. But we should only focus on the things that are moving the market. So with that being said, I wanted to make sure I touch on that because that is such an important gauge that's easy to measure without all the noise and speculation. What are we collectively thinking rates are going to be? Gang, that's the biggest market mover. Unless there's something geopolitical that's going to come out of nowhere, we're not going to see that setting up. It's not a trade because it's not a scheduled high impact, high volatility event. Keep an eye on those scheduled events. And it's easier to stay on the side of the psychology of what so far continues to be very much. And this is not a November, October thing, gang. This is something that's been brewing since June, right? This is a bottoming process that's easily been brewing since June. Okay. And that's what I'll continue to keep an eye on. All right, gang. So let's get to the questions as always. Thank you for being here for Charts and Coffee. Big shout out to our members of the live trading session yesterday for our volume decoded class. Still have 3 more sessions coming up, actually 4, because we have the longer term, which the timing for that could not be better in terms of where we want to position ourselves on weekly time frames. So we still have those 4 sessions coming up and had a great session yesterday. So shout out to those of you that are here and Charts and Coffee. Had a great session with you all. That was a really volatile environment. And then those of you that saw when we stuck with the puts on the Qs for the early part of the morning and those TLT options, as long as we know where our point of validity is, as long as we know how to manage risk, we can still day trade this environment very effectively. All right, first question. Kevin, how are you? 6E is gapping into multiple resistance zones in a neutral environment. Do I like this for a short on the daily? I do. I do. If we're going to see a quick pullback, this is where the conversation begins, which is to say, just as you said, neutral environment, reaching the anchored VWAP, reaching the mean of the V score, good looking chart. I would not jump into it quite yet. I think we want to see the pattern up in here, but the conversation about puts on 6E, shorting 6E, or even the M6E, or puts on the FXE, if it's liquid enough, and this is not a day trade, gang. This is a longer dated trade. I look at the Jan 2096 puts, or sorry, yeah, the 97s are pretty illiquid. The 95s are kind of liquid. The problem is going to be liquidity here, but I like the idea of shorting the euro. And then my Forex traders, euro US. So yeah, let's see if we can't get the pattern. Yeah. All right, next up, Alex, as a fairly new futures day trader. Cool. Fairly new. Please, please, please use micros or smaller position size via fewer minis, right? I'm treating these high impact events like earnings. Yes, that's really what it is. It's a hot zone. Right, exactly. I'll play the build up too. Yeah, as long as you're not in for the event. Love it, Alex. The aftermath of, but not the event itself. Love it. Love it. Well said. Well said. That has served me well. I concur. That's the way I've been dealing with these hot zones for the better part of 20 years. And remember, I know there's a lot of folks want to trade the event, right? Because it's so sexy to be on the right side. Oh, you know what? Hang on, I just remembered something. Thanks, bot. I'll go. I'll sort that out right now. I do have the room open. I just forgot to go live on that one. Hang on. Hang on. Hang on, gang. This light is in my eye. Sorry, gang. I have this light that I got to block every now and then because it blinds me to everything else on my desk. I was supposed to be in the free trading room. There we go. Let me go rectify that right now. All right, we're broadcasting everywhere now. Heads up for the audio coming in on the free trading room. All right, so let's get back to it. So quick coverage, just a quick summary. We are seeing the equity markets move higher, the dollar moving lower, and bond yields still not. Now, I tell you what, let me touch on this while we're all together. Yields are a little interesting here. Initial move higher because yields are dropping as PPI came in cooler, much like CPI came in cooler. It's a little troubling that yields are not sustaining support around that 125 area, which would have been far, far more bullish for equities. Let's keep an eye on ZB. Yesterday, those of you that joined me for the live trading for Volume Decoded saw how challenging the environment can be when we do not have the synchronicity of bonds to equity. So let's keep an eye on this one. This could be a little challenging here. So ultimately, what we want to remember is that core, forget the core, just PPI in general, cumulatively has told us that the cost of goods, these final manufactured goods, is lower than it was expected to be. That really is a very good follow-up on that lower than expected CPI. And ultimately, traders will expect the Federal Reserve to peak around the 5% target rate probability. That 5% area is ultimately, so far, still very much the terminal rate that we are dealing with. So that is the aftermath, bullish for equities. That's the bottom line. All right, next question. What sectors and most weighted stocks within them will be affected if a railroad strike happens? Brian, I don't know. I haven't done any research on that. Easy enough to fix, though. So if I wanted to know that, and I'm not sure I will, but it's a good question. So what we want to do is just go to Google and look at, and I don't know what the answer is in terms of, the only one that's coming to mind in terms of railroads is transportation, right? I would end up thinking about the transportation ETF. And then, so I can't think of an ETF for railroads off the top of my head, but I go right into thinking Norfolk Southern, Union Pacific, CSX, and I think Kansas City Southern. And those are going to be weighted in IYT. Check out IYT, Brian. That might be about as liquid a spot as you can take advantage of. Now, there's no harm in Googling different ETFs. Rail is coming to mind, RAIL. I do not, I mean, look at this is not going to help in terms of wanting to trade Rail. It's under $5. But look at the holdings within Rail. So Brian, what I would recommend you do is head on over to Yahoo or whomever you use. Look at the holdings within the Rail. I think it's a freight car ETF. That's the only one coming to mind right now. But yeah, it's easy enough to go look up. And then what I would say is take a look at the structure of the stocks in IYT. That would be my preference. And then I would go from there. And IYT would be clearly the one that I think will see the broadest, in other words, the broadest group of people will express their opinion about the strike, probably in IYT, which, by the way, Brian, is going to affect DIA, not to the degree, say, financials or healthcare, even tech would, but it will have a bearish effect if we see IYT heading lower. All right. Next up is Apple. Hey there, Kalwan. All right, Apple. What are my thoughts on Apple? Not much, frankly, not really much. It's neutral. It's not really at a level that I can do much with. That would probably be as we close in on 156. Calm. That'll probably be around 156. Hey there, John. How do I use Forex performance? Oh, okay. So if we were going to go to the barometer, the currency barometer, yes. So the question here is, how do we use currencies to understand what the risk appetite or risk aversion is? Remember, again, currencies are the largest market on the planet with really not even a close second, hardly a distant second. It is an enormous market, and it's where the most opinion gets factored in terms of risk appetite and risk aversion. The currency that we look at, to your point, John, is the JPY, and that would be in the Forex world, the dollar yen, euro yen, Aussie yen, all those different ways we can look at yen and other currencies. And then the futures, it would be the JY. Now, in terms of the one-day relative performance, we're right in the middle. I want to see the yen and, frankly, the franc weaker. So let's do this. I'm going to pull up the 6J. Let's go take a look here. And what I want to look at when I look at the 6J here, now remember, these are currencies, and this is essentially the US dollar versus Japanese yen, but it's quoted yen, the base currency. So this is, if the yen is the first currency in the pair, or the base currency, which it is in the Forex, which it is in the futures, this is directionally representative of the yen. If the yen is bullish, this goes up. If the yen is bearish, this goes down, which, by the way, for my Forex traders is opposite with the dollar yen. So you'll see here that we've gone neutral after a prolonged period of a downtrend. Not yet time to buy. It's probably still fairly shortable. And here is why. Take a look at the V-score resistance that we're at right now at about 0.6 standard deviation. And yes, gang, standard deviations are not just 1, 2, 3, 4, right? We tend to want to round them out to these whole numbers. That's not true. If you take a look at the V-score, you know that standard deviations are just, they could be these levels within those whole numbers. And that's where a lot of traders get into trouble. They're just looking for 1, 2, 3, 4 standard deviation. This is a 0.6, negative 0.6. So just below the mean, little bit of resistance. And then we have resistance at the mean. And that means that basically between now and about 76, we're going to see likely resistance on dollar yen. Now, if we want to day trade yen, now realize the price of this thing. Look at the price, 0.007. If you look at something that's 0.007, and then we're trying to determine what the volume is, it's because of the price of the yen, it is going to be a funny looking chart. That's just the nature of the fact that you're dealing with something with such small increments. I mean, we're talking about the third decimal place to begin with. Now, if you're wondering why does that look that way, it's the value of the actual symbol. Because you go on over to 6E, you'll see we're moving in a larger amount of ticks, not 0.00, and then we start to see the movement at the third decimal place. This is happening easily at the second decimal place. So you'll see a little bit better movement. And it's just a function of the price of that thing, right? Yen versus versus euro. But I like that yen on the daily time frame. You see the V score looks beautiful on that daily time frame, and we can see where the resistance is going to be. This will be the first area of resistance. The second, if equities continue to rally, then yen should continue to drop. All right. Okay, next up is Johnson & Johnson. Hey there, Mr. Walker. If I'm looking at Johnson & Johnson and ZB, not much on the daily chart of Johnson & Johnson, but I like. Very choppy. ZB, look, gang, at some point, ZB is going to stop moving in a downtrend. It's inevitable because we continue to see a bounce. By the way, who started the bounce? Yellen did. Yellen started the bounce. And she did that by saying that they might be considering bond buybacks. All right. Extremely bullish for bonds, bearish for yield, which is the same conversation. All right. So now what we need to do is take a look at where our structure is. This is the first significant change in structure since we went bearish back on the 7th of September. Now I've got the 14th and the 15th, right? So between the 11th and the 15th, but 14th and 15th, we closed neutral on our trend. A lot of you wondering, Rog, would a 1, 2, 3 be valid at this point if we were to retest a 122.20? Yes. We can start thinking not dramatically bullishly, although macroeconomically it makes sense to at least be aware of the bullish side of the market. But we can start thinking bullishly in bonds because yields are dropping, and yields are dropping because the macro is changing, and yields are dropping because the target rate probability is leveling off around 5%. And then if we continue to see strength in equities, all of this is going to continue to become what feeds the engine of potentially higher bond prices, lower yields. But we're very early in that process. But at least we're seeing evidence of that process with blue grab candles and a yellow trend. All right, next up is, what is the trading journal that I use? Hey there, Lori. Trading journal. Oh, how I track my trades. It's more really along the line of sort of trading bookkeeping software. And there's two that I use the most, Wingman Tracker, and I've been using Trades Viz quite a bit, linked up with a Tradier account. And I have used TraderSync on and off for the past 2 years, and that's a good one too. So any one of those three, find out which one is best for you. If you trade a combination of futures and options, I would go with probably TradesViz. If you want to have two separate pieces of software, which I don't know why you'd have to, but I still like Wingman Tracker very much. And TraderSync is really good for futures. Yeah, so there's a lot of them out there. Those are the three that I probably got the most miles with. All right. Next up, question from the free trading room is, in terms of shorts, now we're looking at, Karthik, we have some longer term long plays in the Sector Secrets Mastery because we look at day trades like we will in about a minute in the futures room and in the mastery. We look at also swing trades, which we've been putting on the back burner as we're still trying to figure out what kind of messaging and target rate probability is coming from the Federal Reserve. But the weekly time frame, in the midst of all that weakness we saw the last couple months, we've built, I think, 4 or 5 weekly time frame positions in the mastery because that longer term portfolio is another thing that we include in the service. That's where I've been longer term committed. Daily is just now coming into focus. Yeah, so that will be something that either later today in the morning, for sure during our 3 to 4 o'clock mastery conversation, that daily is going to get more and more important and relevant and clearer for us, like this maybe 1, 2, 3 setup on ZB, which by the way would also set up TLT. All right. Robert says, I'm in Google puts. Yeah, that's a nice downtrend. It's a good direction to be in overall. December expiration based off the daily chart with the current rally in tech. So, Robert, I don't know where you triggered these to begin with, so it's kind of hard to give you a breakdown, but here's what I would do and then take from it what you will. So first of all, this is a trend. So I'm going to use my trend layout. Yeah. The places to short Google, just so you can sync it up maybe with what you're doing. And let me grab my drawing tools and I'll show you here. Okay, this is what it would look like. Short the rip, right? That's what a downtrend allows us to do. Rip, rip. This is another rip early into that red right in here. And here's a rip. So if you're timing your puts being bought as we rally into resistance, I'm with you, right? Please do not buy puts in this. This is what Momo chasers do. I know you're not one of those, but if you can better time your entries with the rally into resistance, you're going to pay less for the puts. Your risk is going to be less because your cost basis is less, and you're very close to the point of validity for the trend. Where is the trend no longer valid? And therefore, arguably, where would the trade start to lose its validity? So that is what I would see on Google. I'm bearish with you. Absolutely. I'm absolutely bearish with you. All right, gang. And just like that, I have run over and our time is up. So I will see you all on tomorrow at the Simpler Trading YouTube channel. Free trading room, YouTube. Good to have you this morning. I'll see you all tomorrow, 9 a.m. And we'll see what kind of post-PPI market we're dealing with here today. We can catch up then. Be good to each other, gang.